a concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
Well, now we're going to get the spoken word, as we do frequently on the market, with our chief equity strategist, John Blank, who is sitting right next to me this time, not on Skype.
True enough. True enough.
Always nice to have you here in the studio, John. You wrote not long ago that as far as the market is concerned, consolidation has now happened. Big question, is it enough? Bigger question, is it over?
It's, you know, Terry, the issue you have here with the market is we've been in three regimes. And the first regime from 2009 to 2012 was a three-year regime where the market was underfed price-wise relative to how fundamentals were improving. So there was a deep, long trough of pessimism. In 2012, we entered a period of optimism and reflation where the market's prices rallied above fundamentals from 2012 to basically the middle of 2015, a few months ago. So that was a process, a second regime of being too strong with the fundamentals. What happened now is the fundamentals are flattening and we're up above them, and so valuation correction is what's happening. And we've gone from a 16.5 forward PE to a 15.2 PE. The historical average for the S&P 500 is 14.1. You can do the math. We've done 10% of this. Historically, we've got 10% more. So that's the logic of the valuation correction. You don't need a recession to go down 10% more just to close out that optimism that got it too far. But that doesn't have to happen either. Markets can go and continue on with more optimism. The earnings can come back up and meet in a range-traded market, go sideways for a long time. There's no scenario right now that's certain, and that's uncertainty. Along with that valuation gap is what's driving this market crazy.
All right, what about the Fed flinch? Did that spook the markets?
Well, the Fed flinch is not helping because when the Fed flinches, that means the earnings are not getting strong enough to take up the valuation by saying, hey, you know, earnings are going to rise, the economy's strong. When the Fed doesn't raise rates, they're saying we still need to stimulate this economy because it is flattening because of the strong dollar. Yeah. It is flattening because of weak oil, cutbacks in industrial commodities and things like that. So when they don't do that, we're not getting the bull scenario that says, hey, those earnings are going to rise to meet these higher prices. Don't worry about it. That gets off the table. Then that's more uncertainty for the other two scenarios, that we're going to go into a correction or recession, or we're just going to go sideways, and that is a net negative for the market.
We're sitting here talking on September the 24th. This evening, Fed Chief Yellen gives a speech on inflation and Fed policy, and a lot of eyes are on that speech as well to see if she tips her hand at the timeline for this rate increase that everyone is anticipating. You think she's going to take advantage of that?
I don't think so. It's too soon after the Federal Open Market Committee meeting, and she has no incentive to get in front of herself because they're data dependent. So what she will wait for is more data. Since it's only been a week, there's no new data. So she has nothing new to present. It will be a university kind of academic speech, probably something that she's done as a to-do list that she's had for a long time. I wouldn't bet on anything in this meeting because if you're looking at the Fed futures, the December read is a 40% call now, less than 50 for a December rate hike. And that means the market's going to have to wait for is pretty much November or even early December to see what the kinds of payroll data that come in, the kinds of things that happen. And the other problem right now is we're seeing job cuts. We're seeing job cuts at HP. We're seeing it at Caterpillar.
Yes.
Now we've got this VW thing on our hands. So that's an industrial company, job cuts. That's not going to be favorable to what has been favorable, which is the strong job market. That's just another level of uncertainty. It's all going to lead her to say, let me wait for another month or two to see what that all nets out to be. So she'll definitely not have anything to say tonight.
And with all the other market headwinds out there, let's not forget mutual funds may be doing some tax loss selling here in the not too distant future. That may pressure the market downward a little bit more, huh?
Well, I hear that in the marketplace. Obviously, I don't think there's any mutual fund that's up for the year. It's almost impossible to have avoided this correction unless you were out of the market or you were an inverse ETF, short fund. So they're all down. How much do you have to do that when everybody else is down is the question, right? I mean, it's not like there's sectors that are down or there's groups that you can do some trimming of the tree. The whole tree is losing its leaves. So let's see what happens. If I were a mutual fund, I'm not being pressured to meet my benchmarks. My competitors are certainly doing no better than I am.
All right, yet, in spite of everything that we've said, you have identified some industries and a couple of stocks here that are worth taking a second look at. You say utilities and telcos got some big upgrades. Energy got an interesting upgrade as far as the sector is concerned. So, and healthcare remains very attractive. And in that group, Universal Health Services is a stock that you're taking a second look at.
Yeah, ticker UHS, Universal Health Services. This company, they have pods of services, you know, ambulatory care, different types of preventive medicine, different things that they are offering the marketplace, and that they have a business model that seems to be working, and that's a very defensive, you know, strategy right from the market. You want to look at these companies that are in healthcare that are not in the biotech, you know, overvaluation area, but in this spot that's not so overvalued.
Okay, and then utilities got upgraded to very attractive, and therein you're looking at Centrica. And this is a long ticker, CPYYY.
Right, Centrica is an interesting play to think about. Here you've got a natural gas utility. And what's happening here is, it's again a very defensive sector. Prices for natural gas to the consumer are set by your regulator. So the end price to the customer is fixed. The feedstocks of natural gas, whether they're hedged or not, that's the question mark, but even the unhedged part is coming in better for you. So you have over time, as this energy market continues to collapse, the hedges get set lower or they come off and you have more feedstocks at a lower price. So margins of natural gas utilities are expanding because their end customer price is fixed and the bottom's found out of their feedstocks. So Centrica is a sleeper example of the types of companies that you're looking for in a market like this.
All right, John, thanks for stopping by. And if you are watching our videos out in syndication land and you're on the YouTube platform, a reminder here that you can always subscribe to our videos off of that platform, and you can even comment on them while you're there watching. You can watch more videos on Zacks.com as well, where you can get more market commentary, earnings commentary, and stock commentary, among other things. So you might want to go to the homepage and check out Zacks.com. With John Blank, I'm Terry Ruffalo.